It's Red Thursday here in Kansas City, but it's also a time for Jimmy and Mark to get together. The combination between the Mistake-Free Real Estate Podcast and the Rise Up, Live Free Podcast. You're going to hear today why we believe it's a time for you to continue to buy assets in this high interest rate environment and why it's going to have you primed to thrive when you come out of it on the back end. Check this episode out. We hope you enjoy it. Welcome to another collab between the Rise Up, Live Free Podcast and the Mistake-Free Real Estate Podcast. I got my mate Jimmy Vreeland on here. Jimmy, how are we thriving through a high interest rate environment? I know you just got off the mat. You've been rolling up jiu-jitsu today. You're pretty fired up, buddy.
I am. I got the endorphins going this afternoon. This is why I love rolling at lunch. You get nice and fired up for the rest of the day.
I love it. Well, hey, interest rates are high. People are complaining. What are you saying to all these people that are complaining, man? How are we thriving in this environment?
Well, first of all, number one, it's a rule my dad taught me: never complain. And number two, I believe we went from selling one of not so much scarce, but we've always been in the industry of selling shelter, one of Maslow's 5 hierarchy of needs, right, Mark?
For sure.
And we used to be selling, we were selling just an average commodity. I think we've gotten to the point where we're selling a not a precious commodity, but a rare commodity.
Rare, no doubt. Yeah, supply is crazy low. Actually, for those of you who are listening on podcast right now, if you want to switch to YouTube, we're actually going to use a slide deck today. So I will say, if you want to prefer to watch this on YouTube, please do. We'll do our best for the podcast audience to go ahead and explain what we're looking at. But Jimmy, go ahead and share screen, mate. I know you've got it pulled up. Pull up the Mueller's 4 market cycles, because I think it's important, first of all, to talk through where are we, in the market cycles. Mueller talks about the recession and then the expansion phase, then hypersupply, and then coming back into recession. And I think it's important to understand where we are in those cycles. Kenny, that's perfect. Thanks for teeing that up. So I think there's been a misconception. I had to check myself, Jimmy, because I had always been telling people that we were kind of peaking from phase 2 into phase 3, from expansion phase into hypersupply. But mate, the one thing that's different from the other expansion phase triggers markets that we've been in is there is such a severe shortage of real estate right now. So I believe we're firmly in the trench of expansion phase in the Midwest.
And then let me give for the audience a little bit of history. The first time I think we saw this was at CG. Big shout out to Collective Genius. I got my CG t-shirt on today for those of you on YouTube. But first time I saw this, Mark, the whole room, I think this was in 2019. A lot of the room thought we were right here, right past expansion, about to go to hypersupply, right?
Yep.
And then we were all expecting a recession 2020. The pandemic hit, yada, yada, yada. We all remember those versions of history. And, in some moments, I thought we were down here in between hypersupply and about to go into recession, right?
Yep.
And then I do think where Mueller might be a little different is this is a 2-dimensional graph where I think it's like, you ever seen Interstellar?
No.
Oh my God, it's a great movie, but they showed this like 8 dimensions of everything, right? Where I think you got to look at this at least as a 3-dimensional graph, because I don't think the entire market or the entire real estate market operates on this curve. I think it's a nice concept to see how it goes, but to say the entire real estate market nationwide or internationally goes on this curve, I think is incorrect.
Well, the other thing you've got to understand is you can take it from a macro approach or a micro approach. I mean, I think that there are areas that are in a recession right now. I think if you're looking at increased vacancy and more completions and less construction, then I think you've got to say that office right now is in a recession. I was had a big boy lunch yesterday with one of my local mentors, and he was saying how.
Well, wait, Mark, do we want to tell the audience the real name of these lunches?
Go ahead.
Lunch with rich guys.
Rich guy lunches.
Rich guy lunches.
Yeah, people you look up to.
It's a great way to build a business.
Yeah. So I was having a rich guy lunch and was understanding that office is truly taking a hit. They are offering it at 90 cents on the dollar. And he was saying until it gets to 60 or 50 cents on the dollar, he's not even going to look at it. So he sees a real recession. Specifically, again, now you go niche. This is Kansas City, and he's talking B and C class assets. He said the A is a little bit more sheltered. The A class assets are there. but there's massive, pressure from employees on employers to say, hey, we made it through COVID. We can work from home. Let's stay at home.
So I obviously COVID was definitely a black swan event, but I think a black swan ripple event was this lifestyle thing of working from home.
Yeah.
It's just, who would have expected that? Like, we have a remote team. I absolutely adore it, love it, but no way do I think we could have sold it to the team without COVID.
Yeah. Okay, so just moving along, I know we have more slides to get to. So the market cycle quadrants, I actually researched this in detail yesterday in prep for the show, Jimmy. And what I saw was that rents are still rising. There's high rent growth in a tight market with very little supply, and that is definitively expansion phase. So we are not yet in hyper supply. We will know that when rent growth is stifled, and is no longer getting strong rent growth, and we start seeing an oversupply of inventory. Remember that pendulum we talk about where you've got about 5 to 6 months of inventory supply on the market. Right now in Kansas City, we're still at 2. I assume that we've gone from 1.8 to 2 over the last 12 months. So it's very slowly the pendulum is swinging back to normal because there's just a lack of supply of housing. I sense that's the case all through the Midwest, and I don't see that pendulum coming back even to normal for quite some time.
And then here's a question I just got. So if you're watching on YouTube, if you look at phase 1 recovery, no new construction.
Yeah.
Now you could make an argument. I want to use the word artificial, but there's been no new construction, or not enough new construction, for 15 years because of the beating everybody took in 2008, right?
Yeah.
Now there's no new home starts because of interest rates. So what does that mean for this chart?
So I had another call it a rich guy lunch, although it may not be in some years time. I feel bad for the guy dealing with a new construction builder, and Jimmy, he's hurting. Interest rates rising for him are not just decreasing the buyer pool, that increases carrying costs. Most construction loans are on a variable interest rate. So he's now paying on completed projects 20 grand a month on his interest carry just to keep these projects afloat. And he's still not selling them, and discounting the sales price is not selling them, and interest rate reduction or interest rate buy down is not selling them. So he is in a world of hurt. Those are in the $700,000 to $800,000 price bracket here in Kansas City, and just feeling super bad for the guy because he's needing an exit. And he went out and built a bunch of spec houses because it was, a great time to do so. But I know, hey, look, we're short on time. I want you to click off that. Let's go to your slide deck because I know you've got a few slides to talk to. And if you can jump to the housing market one that addresses population and housing supply first, and then we'll come back to you betting against the champ. But go to the housing one that talks through the population increase in the U.S. because, that one there. So if you can expand that a little bit, what this is, you talk through what this is saying right here.
Yeah, so this is from the Census Bureau. I didn't just make this up. Are you proud of me for actually doing homework?
Homework, mate. You're good at it.
So if you look since, I was curious, like how much has the United States population increased since the Great Recession? So our 2020 census says there was 330 million Americans.
Yep.
That is a 22 million increase since 2010.
Yep.
So that is a 7.4% increase in population. So even though the home builders were scared about new houses, right, Mark, people still had babies.
Yes.
Population continuing to increase. This is still the greatest country on earth, and people are still flocking to it. So now we only had total housing units of 140 million at the end of 2020. And that is only a 6.7 increase. So housing did not increase commensurate with population in the last 10 years.
Yep. So
that's where the thesis I'm rolling with and what I'm seeing on Main Street is that there's just I don't know what we were selling before 2020, but I know right now we're not selling a rare commodity, or we're not selling a precious commodity like a diamond, but we're definitely selling a rare commodity.
Jimmy, if you are someone who's sitting you're living in a $400,000 house in the Midwest, middle America, you've got a 3% fixed for 30 interest rate, and now you're going to turn around and go to an 8 or 7 to 8% interest rate conservatively on a 30-year fixed. How can you even afford the same house, let alone increasing, going from a 400,000 maybe to a $700,000 house.
Well, I hope you refied in 2020 and got 30-year fixed.
No, they did. But my point being, so that is going to stop people from moving. So there's going to be a lack of organic supply from those that are just moving and buying a new home. Let's say that they were going to go from a $400,000 home built in the 80s to now a $700,000 new construction build. That person is now going to pause and not buy the $700,000 or $800,000 home. Therefore, not only not buying from the builder, but restricting the flow of trades that would come in knowing that they were going to sell their home. Exactly.
So there's just going to be, it's hard to find houses right now.
Yeah.
Now, if you have a team that has a special set of skills that knows how to find these houses through direct to seller marketing, you're in a pretty positive position. Or let's say you listen to a podcast with two guys who knew how to do that. That's probably a decent podcast to listen to.
Yeah, but I think there's certainly my audience, and likely yours as well. If they are thinking that they're going to sit back and take advantage of, some kind of mini recession or plateau in the marketplace right now, I think that there's a gap there. The way that they can take advantage of what's coming down the road is by partnering with operators that are going to bring deal flow to the table. Dude, you've had your teeth kicked in on flips and budget overruns and material supplies and contractors not showing up. And for those that think they're going to try and come in and learn that game right now when they're operating as a dentist or a doctor or a lawyer or a sales guy, I don't think that's going to happen.
Why would you? Oh my God, why would you take your ball off your cash machine? I sold a couple of houses to a dentist a couple of days ago, and he's like, recession this, recession that. I'm like, I don't understand why you care. And he's like, well, what do you mean, Jimmy? I'm like, people still have teeth in recessions. Like, I don't understand why that would affect your business.
Yeah.
I think like you can get, one of my favorite Ray Dalio lines is, he talks about his last book is something like The New Economic Order, but here's the bottom line truth. In most natural disasters, in most hot shooting wars, and in most recessions, everybody survives. Everybody does pretty well. Like most recessions, most people kept their job, to include the Great Depression and the Great Recession. Most natural disasters, most people's houses stay intact. And I know this from personal experience. Most hot shooting wars, most people survive unscathed. So like the worst thing about combat was thinking about combat. And I think the worst thing about a recession is thinking about a recession.
Amen. Okay, let's go back. We got a slide deck to get through today. Let's try and power through it because I know you've got a little mini presentation of some of you're going the wrong. Yep, back the other way.
Oops, I'm going the wrong way.
So let's start with betting against the champ. It's just kind of some hot takes here from, our thoughts on the marketplace. This was actually taken from going to be our keynote speaker coming up at Collective Genius, a guy by the name of Barry Habib, who's a mortgage broker and prognosticator. He has a big mortgage company, but he is a prognosticator. He is forecasting and predicting unashamedly what is going to come through the pipeline. So we've really looked at him as someone who has clearly and concisely forecast. I think he's won the Crystal Ball Award they give out to the mortgage and interest rate industry 3 times. So clearly a sharp guy, knows what he's talking about, and he talks about not betting against the champ. What do you mean by that, Jimmy?
So in the last 73 years, there's only been 7 years where the median home price has gone down. And if you look, 5 of those 7 years were during the Great Recession.
Yeah. 2007 through 2011. 7, 8, 9, 10, 11, housing prices went down. And then you've got a small blip on the radar with the dot-com crisis. 90 and 91.
Yeah, that was like the grungy Pearl Jam recession where, we just came out of the Gulf War.
Yep.
And then everybody got so angry because housing prices went down 1% and the whole grunge movement came.
That's interesting. In the dot-com bubble, we had a 7% and a 10% increase in 01, 02. So yeah, I mean, the champ has gone 73, 7, and 1 ever since 1941. Interesting.
Well, if you remember correctly, to get out of the dot-com bubble, they drastically lowered interest rates and intentionally used real estate to prop up the economy.
I'll let you kind of roll through this.
Yeah, this is just a simple graph that says inflation drives mortgage rates. So like the Fed has a very blunt object in order to forestall inflation, and it's raise the interest rate. Like I think that I've been saying this for over a year now. You've heard me say this on this podcast a year ago, Mark. I've been excited about the rent rate, about inflation going, or the interest rates going up. It shows the economy still has juice in the tank. Like, let's say there is some black swan catastrophic event. The Fed can now lower interest rates. Let's say this is 2021 and interest rates were zero. And let's say World War III started. What would they have done? They would have had to gone negative interest rates. And then the hyperinflation was guaranteed to happen. So this just says, hey, this is what the Fed does to control inflation. When interest rates goes up, recessions occur. It's just how, it always happens. Now, as a real estate investor, recessions are coming, Mark. What's going to happen to my rents? My rents are going to go down. My whole portfolio is going to fall apart, right?
No, sir.
The graphs would not say so. Between 1910 and 1923, we're in a little bit of a hockey stick as far as rents going up, right?
Yep.
I would say that's due to population growth and inflation. And then, so if you're looking at this graph on YouTube, all the gray spots are recessions. And so you'll see a little rent flattening after recessions. That's kind of interesting. What about during hyperinflation? Should we be afraid of rents going down at that point, Mark?
No.
The data would say no. There was a steep, not exactly hockey stick effect last time we experienced hyperinflation, but as always, rents definitely went up. In our lifetime, look at the curve on rents. Is there anything else in the economy that looks like this?
Pretty darn stable.
A constant, gradual increase.
Yeah.
Like, this is why you got to own these assets for 10 years. This is why this is awesome.
Yeah, it's the turtle wins the race. And that's why it's not a sexy game, is because you don't see these, massive spikes where you can double your money in 1 year. But gosh, it sure looks like you can double your money every 15 to 20.
Yeah, you shouldn't be getting this game to try to do that. Like, I coach people, hey, take your tranche of safe capital and send it to us. And then go do your high tech, high volume stocks and like double your money.
Yeah.
But we are like your steady Eddie. We've done a couple podcasts. We're your Caddyshack investing. We get no respect, but we're always there. Vacancy rates during recession. So you may see a spike in vacancy rates in the beginning of recession. And what you experienced this in 2008, but all that happened is A-class tenants got evicted from A-class assets and became B-class renters.
Yeah. We actually changed our criteria. Before we had said, no foreclosure or bankruptcy. And suddenly we're like, man, this guy's just been foreclosed on, but he was in an $800,000 house. And now he's trying to rent this little $150,000 house and kind of get back. And he's got income that's $150,000 a year. Why would we not rent to the guy? So you kind of change your tactic there to make sure that you open up the bandwidth and look at people with more of a clear lens for the carnage that just happened. At least this is after 2008 and 2009. But yeah, I could see something like that.
So if like the first 5 months of a recession, like vacancy goes up, like don't panic, a better renter's coming.
Yep.
And then, so the only way I can make sense of this is, here is the housing supply. There's 3 months of inventory nationwide. In the Midwest, there's about 6 weeks.
Yeah.
And dude, that's 6 weeks. We've been talking about that for 2 years now.
Yes.
This is just same. John Burns says the same thing. I thought this was very interesting. A 55% decrease in new home construction since 2006.
Wow.
Dude, that's a big, long trend.
Yeah, I threw up a chart one time. Maybe Pete, you can grab this and throw it back on the podcast. But there was a chart that showed the new construction for the 5 previous decades, from the 70s, 80s, 90s, 2000s, and then in 2010. The 4 decades prior to 2010, we'd consistently had housing starts of around 20. It was either 22 or 25 million. I think it was 25 million every year. And then there was only 5.6 million in the decade of 2010 through 2020. So, clearly this is reporting it. It's a massive housing shortage that we're still trying to clear our way out of. Because remember, you're not only now trying to get catch up from the previous decade where you had 15 million more homes less than what we should have absorbed, but now you've also got to do the 20 million for the next decade to keep up with the increase in population.
It's very interesting.
So what's this leading to? So yeah, big question, right? Is what is people, what are people's takeaways? So clearly, yes, we're in a high interest rate environment. I believe that we are going to plateau and that we are not going to continue to see interest rates rise. I don't know if you caught this, Jimmy, but there was a letter that was sent to the Federal Reserve Bank on October 10th. So that was just 2 days ago at the time of this recording. And it was a joint letter from the National Association of Home Builders, the Mortgage Bankers Association, and the National Association of Realtors. Those three housing specific institutions sent a joint letter to the Fed saying, this is dire straits. We need you to come out and publicly say you're not going to raise interest rates again, because they fear that if they go up into the 9, 10, 11, it truly is going to throw us into, very, very strange times in the housing market, and new builders specifically are going to go and just, bury the head in the sand. And so that was an interesting turnabout. I believe that they will be forced. And again, these kind of higher level institutions that are putting pressure on the Fed, I believe that we've seen the last of the rate hikes, and that I believe will stay here. And then again, this is just my opinion now, so take it with a grain of salt. But I believe that sometime in March or April, they'll do a interest rate reduction to try and spur on a really strong summer of moving activity, where someone can actually get a rate that might be in the sixes for a single family home and be in the sevens for a non-owner occupied investment property. I think it's going to be a bleak winter, Jimmy, as far as like retail home sales, but that leads to opportunity for guys like you and I. I'm going to go for a counterintuitive prediction. You ready for it? Yep.
What you just described, I think would be the worst thing for our investors. I think what our investors are buying right now is the gap between, hey, the hedge funds are taking a break. And that's what I've been selling for the last year is hedge funds are taking a break. Interest rates go down. You will be paying a lot more to get in this game.
Right.
And then you think what's that?
Well, for clarity, so that is my prediction on where interest rates stand. Now, how investors that are listening to this podcast can take advantage, I do not think, and let me be very clear, I do not think it is a wait and see mentality. I think that would be absolutely the worst case scenario for them for this reason. When interest rates come back down, the value of the assets that are currently being held is going to go up. I have no doubt that lower interest rates will cause a greater demand. And with a still lack of supply, I think that the value of the homes will go up. So it will benefit those that are still holding assets.
Yeah. But to get in this game, it's going to get harder. Like this, I believe this is the gap before the storm.
So what are you telling your investors to do in this time period right now?
The same thing we've been telling them the last 10 years. Don't wait to buy real estate and wait. But the deal you're getting right now is you're getting a hedge against inflation. You're getting in on a finer asset that you could have got in on 2 years ago because the hedge funds were pricing everybody out of the market. If interest rates go down, prices are going to skyrocket. And I don't think, I just think everybody needs to get rid of their obsession with first-year cash flow. Yeah. It's the worst metric ever to measure a buying decision on.
The other thing about first-year cash flow, I mean, we talk about the 4 pillars all the time, leverage, appreciation, depreciation, or tax advantages, as well as the cash flow. The one thing we don't talk about enough, Jimmy, probably is, and maybe it's a cause of the leverage, but it also is a factor on cash flow. When we have a fully amortized loan, one that's paying principal and interest, you are paying yourself back every single year. You are getting cash flow. You're just choosing to put it in your other pocket and pay down your debt. So, those that are arguing there's zero cash flow, I would argue, well, it's actually cash flow positive. You're just choosing to turn around and put $4 or $5 grand to pay down your mortgage through the principal reduction every year. So principal reduction should be a factor when people are looking at whether they should invest in real estate or not.
Well, I mean, and that is legitimately true wealth building. Like cash flow is simply just a permission slip. Like, I wouldn't buy rentals in California if I had to be feeding it $1,500 $1,500 a month and the tenant couldn't cover the mortgage, right? So your first year cash flow is just a permission slip. Am I gonna have to feed the meter every month? Or even if I have to feed the meter a little every month, like, is that cool? If it is, all right, cool. I'm building wealth. I'm buying a long-term asset.
Yeah, heard.
Because the other thing is like, so what this is leading to, should we do it in the Tech 9 style or should we just say
it? So, hey, it's Chiefs Friday, right? So
Chiefs Thursday.
Chiefs Thursday. Gosh, that is weird. I know it's not Red Friday. It's Red Thursday. Chiefs are playing tonight. There's a song out there, Tech 9, that is Red Kingdom.
My kids love that song.
Yeah. Welcome to the
Renter Nation.
There we go. So this is what we're turning to now. Renter Nation.
Like, I do think this will be, by the way, I do have John Burns' book on my desk. I was reading through it, Big Shifts Ahead, where he just talks about before all these COVID shenanigans, this was written in 2019, like millennials don't buy houses like our generation. you and me got out of college, was like, your best investment's your house. And they were right. But millennials saw their parents get slaughtered in 08, and they don't feel that way about real estate.
Yep.
So that being said, we were moving to a renter nation before COVID. Now I just think the gas has just been gone in that way. So like I think when we want to shut it down, Mark, I think we'll sell our portfolios to an institution. I think most of our buyers, when they want to shut it down, they'll sell their houses to an institution. Yeah. So if this isn't necessarily, this is speculation, but if you want to get in on Renter Nation, now is the time.
Yeah, we're certainly heading that way. And, thriving in a high interest rate environment, to summarize, I think is you've got to take advantage of asset accumulation. I think this is an asset accumulation phase, and then the appreciation will come when interest rates drop again.
Well, I think that's what I learned from 2020. I messed up on this. I didn't refi everything. But the people who benefited from that low interest rate environment were the people who already had assets.
Yeah, I mean, I'm a classic example. I mean, I don't know what it was, 65 assets that I'd just been accumulating consistently, one a quarter for the last, 10 years or so. And all of a sudden you wake up, you got 60 doors and there was a chance to refi onto one long-term note. So I locked in 3.25 fixed for 10 years in 2020. So I'm good through till 2030. At 3.25%. And the coolest thing there was not just seeing the appreciation that all these assets had taken over that time period. Obviously, they've gone up a lot more since then, but also the fact you can do a cash out refi. And that's the other thing, the cash flow comes from a cash out refi, but you've got to own assets to be able to take advantage of that. I had a massive cash liquidity event when I refied to pull the cash out of some of those assets just from they'd gone up so much in value. And with rents increasing over that time period, it was still cash flow positive, despite me pulling out, a lot of capital from that refi event.
Let me ask you this. What have you enjoyed more? Watching your P&L every month? Like, oh, did I get my $200 of cash flow this month? Or, hey, I'm going to wait 10 years. I'm just going to refi everything out. Like that.
Crockpot,
that's
right?
The real cash flow that no one's talking about. It goes back to your whole equity pay down.
Yeah, the equity pay down. You wake up and you're like, my gosh, I've got an $8 million portfolio. I only own 2.3. How's that happen? Well, I've paid it down $1 million over the past decade, and you've got this massive amount of appreciation. So, yes, equity is earned over time. It's not bought up front. So I'm a big believer in the buy and hold. And yeah, we're telling all our investors right now, look, I know it's tough to stomach, when you come in, you get a 7.5% interest rate, but that's a temporary pain point to be able to enjoy the long-term benefit of the appreciation upside of your asset.
But it's not a pain point. You're buying the gap right now. You have to pay 7.5% to not compete with a hedge fund.
Yeah.
I'm grateful for my 7.5% mortgages right now.
Perspective. I hear it. All right, dude. Let's wrap for everybody. I know this was a quick podcast, a hot take. By the way, we're going to do a CG wrap also. So if you want to look out for that podcast coming soon, we'll definitely bring you up to speed on all things that happened at our most recent Q3 out in San Diego, California. Jimmy, any last takes on high interest rate environments or advice for your investors that are sitting on the fence?
When you can win a game in 4 ways, it does not matter what's happening on the market. All we're doing right now is we're pulling. So 2020, we were pulling the leverage, getting those low. You're buying paper. You were pulling the leverage pillar. I'd say, 17, 18, 19. I do think you were pulling the cash flow lever.
Yep.
And I'd say right now you're pulling the 5th pillar, beat inflation, and the appreciation pillar.
Yep.
So just like the other thing about your story, Mark, is you just followed a process. You didn't really care what was going on in the market.
No, you don't look at current market valuation when you're buying an asset, right? You're looking at, what is it going to do for me long-term? Is it a good area and a good, my take on all this, my final take would be, if you're looking at an asset, where am I going to be in 10 years time? Is it going to be an asset that increases in value, that's in a good school district, that will continue to get rented with dialed-in property managers that can maintain and efficiently monetize the asset throughout that next time period? 1 year mindset when you're thinking long-term is a narrow and really a flawed model.
I am going to spend so much time in investor purgatory for selling assets like that for as long as we did.
Yes. All right, mate. Hey, it's almost like we are rigging the game in people's favor. And for those that want to know how to rig the game, go check out our next podcast coming soon. Rigging the game was the theme of the CG event. But for now, going to wrap. Jimmy, say goodbye to everybody.
Bye, everybody.
Thanks, guys. Talk to you soon.